Welcome, focused learners. So we're diving straight in today. This explainer is literally your cure for real estate math anxiety. We're going to give you the exact tools you need to spot and completely disarm those sneaky traps hiding in the Florida Real Estate Sales Associate exam. Think of this as your ultimate survival guide to totally conquering the math section.
Okay, here's our roadmap for today. First, decoding LTV and points. Second, calculating ad valorem taxes. Third, prorating taxes at closing. Fourth, simple interest calculations. And finally, a real estate math quiz to test your skills. All right, let's jump right into Section 1, decoding LTV and points. So let's start with the foundation here. The loan-to-value, or LTV, is a simple but absolutely critical relationship. It essentially shows what chunk of the property's value you're borrowing versus the portion you're paying upfront in cash. The LTV and the down payment percentage, they will always add up to exactly 100%. So if you've got an 80% LTV, that means you're looking at a 20% down payment. Easy enough, right? But wait, here comes your very first major trap alert. When you read an exam question, you'll often see two different numbers thrown at you, the contract sales price and the appraised value. Listen carefully. Lenders always, and I mean always, calculate the LTV using the lesser of those two numbers. They literally never automatically default to the higher asking price. Let's see exactly how this trap works in practice. Say a home contracts at $350,000, but oh no, it only appraises at $320,000. Your base value is that lower number, $320,000. So an 80% LTV gives you a maximum loan of $256,000. But here's the kicker. The seller still expects the full contract price. So your required down payment is that $350,000 contract price minus the $256,000 loan, meaning you have to bring $94,000 to closing. Now notice the heavy emphasis on the word loan here. Discount points are essentially prepaid interest to lower a borrower's rate. And a discount point is always 1% of the loan amount, never ever the purchase price. If you calculate points based on the sales price, you are going to fall right through a massive exam trapdoor. Moving right along to Section 2, calculating ad valorem taxes. Okay, so property taxes in Florida are calculated using millage rates. 1 mil basically means $1 of tax for every $1,000 of taxable value. To avoid completely messing up your division on the exam, just remember you can simply convert mils to a decimal by dividing the millage rate by 1,000. So 20 mils, that becomes 0.020. And hey, if the exam asks for a monthly figure, you just divide your final annual tax by 12. Simple as that. And this exact progression you see here is how you avoid the next major trap. You absolutely cannot just multiply the mill rate by the market value. No way. You've got to calculate the assessed value first. Like in this example, an $800,000 market value multiplied by a 12% assessment rate gives you an assessed value of $96,000. Only then do you multiply by your mill rate decimal, which is 0.02250, to find your annual tax of $2,160. All right, Section 3, prorating taxes at closing. So Florida proration math usually uses a strict 365-day calendar year method. The absolute most crucial point on this timeline is exactly who owns the property on the day of closing. On the Florida exam, the day of closing belongs to the buyer. Let me repeat that. The buyer owns the closing day. That means the seller only pays for the days up to the day before closing. It's a debit to the seller and a credit to the buyer. You definitely want to contrast this with delinquent unpaid taxes from prior years, which are always just a strict debit to the seller only. And that brings us to Section 4. Simple interest calculations. This formula right here, it is going to be your best friend on the exam. It allows you to take an annual interest amount and break it down into daily rates, which you absolutely need for accurate prorations when a buyer assumes a seller's loan. The whole process is actually totally logical. First, you find the annual interest by multiplying the loan balance by the interest rate. Then, you divide that by 365 to get the daily interest rate. Finally, just multiply that daily rate by the number of days the seller owned the property in the month of closing, and boom, you find the exact proration debit. Okay, it's time for Section 5, the real estate math quiz. Here's how this is going to work. I'll read a question aloud, you hit pause on the explainer to solve it yourself, and then we'll expose the trapdoor together. Ready? Let's do this. Question 1. A buyer contracts a home for $350,000. It appraises at $320,000. The lender approves an 80% LTV loan. What is the buyer's required down payment? Pause the explainer right now, work out the math, and try to remember that base value trap we discussed earlier.
Okay, let's see how you did. The base value for the loan is $320,000 because remember, the lender uses the lower of the contract price or the appraisal. 80% of that is a loan of $256,000. But wait, the seller still demands the full contract price. So $350,000 minus the loan amount equals a required down payment of $94,000. Be honest, if you used the $350,000 contract price for the LTV, you totally fell for the trap.
Let's move on to question 2. A buyer purchases a $300,000 home and gets an 80% LTV loan. The lender charges 3 discount points. So, what is the dollar cost of the points? Read the scenario carefully, pause the explainer, and calculate the cost of those 3 points. All right, let's dive into the solution. First, find the loan amount. 80% of $300,000 is $240,000. Now, 3 points equals 3% of the loan. So, $240,000 multiplied by 0.03 equals $7,200. The sneaky trap here was calculating your 3% on the $300,000 purchase price. Remember, points are strictly 100% tied to the loan amount.
Up next, question 3. A property's market value is $450,000. The assessment rate is 25%, with a tax rate of 70.50 mils. What are the annual property taxes? Go ahead and pause here, work through the progression, and make absolute sure you don't skip the most crucial first step.
Let's check your work. So, the crucial point here is finding the assessed value first. $450,000 multiplied by 25% is $112,500. Next, you convert the mils to a decimal by dividing by 1,000, which gives us 0.07050. Multiply that by your assessed value, and you get annual taxes of $7,931.25. If you just went ahead and multiplied the mils directly by the $450,000 market value, well, the trapdoor opened right up on you.
All right, here is your final test. Annual taxes are $4,380. Closing is June 18th. Using the 365-day method, what is the seller's prorated debit at closing? Pause the explainer, calculate the daily rate, and count those days super carefully. Let's break this one down together. The daily rate is $4,380 divided by 365, which is exactly $12 a day. Now, pay super close attention to the day count here. The exam desperately wants you to count June 18th for the seller. But because the buyer owns the day of closing, the seller only pays from January 1st to June 17th. That is exactly 168 days. So 168 days multiplied by $12 equals a seller debit of $2,016.
Look at that, you made it. You now know the core formulas, and far more importantly, you know exactly how the exam writers try to trick you. Master the base value for LTV, remember that points apply to loans, calculate taxes on assessed values, and always give the closing day to the buyer. But honestly, don't stop here. Think about it. What other exam traps are out there just waiting to be disarmed? Have you mastered the rounding up rule for Florida documentary stamp taxes yet, or how to calculate vacancy rates? Keep practicing, stay incredibly focused, and go conquer that exam. Good luck!